The main question I often get from clients is this: Maurice, the market seems to be at an all-time high, and typically we see a crisis period once every 10 years, where the market seems to drop significantly. We've achieved a nice return in our portfolio so far, and we are considering stepping out of the market for now, keeping the money liquid and waiting to see what the market does. And we can always re-enter later if the market goes down, right? What do you think of this? And this is a great question, one that I'm always happy to answer. And in this video, we are going to explore this question through some historical simulations. What would happen if you step out of the market? Because, of course, it all depends on your personal financial situation. Because if you are a retiree, for example, and will need the money within the next 3 years, it's wise to reduce the risk and move the money to a savings account. And this way you can ensure that the funds are available when you need them for your living expenses. But what if you don't need the money for the next 10 years? What is the alternative you have? What you can buy, for example? In this video, I will explain why stepping out of the market could be riskier than stay into the market. But before we dive in, it's important to understand that there are actually two key moments you will need to time correctly. What do I mean by this? I will explain this by a short example, because during the COVID period, a client called me because he had no longer trusted the stock market. And he had some valid concerns, right? When you step out of the market, there's always that question of when to step back in again, right? Because when you stay out, history shows that staying out for too long can be just as damaging as a market downturn itself. If you stay out for several years, you are almost guaranteed to lose purchasing power because of inflation and taxes, even if the market doesn't decline. So even if you manage to time the market correctly before a downturn and you are the lucky one, you have to be aware that this is just one half of the battle. So what do I mean by this? When you step out of the market and you have a longer horizon for your money, at some point you need to step back in and time the exact right moment, right? And this is why most people go wrong. And sadly, the reality is nobody can consistently predict both the market's peak and its bottom. For example, during a downturn, emotions like fear take over, and it becomes difficult to re-enter the market when everything looks grim. And history shows that markets often recover quickly. And if you miss even a few of the best recovery days, you can miss out on significant gains. In other words, timing the market requires being right twice. Once when you exit and once when you re-enter the market. And even professional investors with all their data and expertise rarely get it right. So here are some important facts to remember. The stock market does surprisingly well in recessions. In years with a recession, the S&P 500 lost 1% on average. And here's how the US market performed in years with a recession and the years following a recession dating back to 1945. There are two critical points to understand from this chart. Number one, the market had positive returns in about half of all recessions since World War II. Number two, some of the best returns you will ever see in the stock market come the year after a market crash. In years following a recession, the market returned 16.9% on average. So recessions don't always mean the stock market will crash. And even if it does, it tends to rebound in the following years. So in March 2020, global markets were in total chaos. There was massive uncertainty due to worldwide lockdowns, businesses shutting down, and millions of people losing jobs. So can you remember that time? And on top of that, there was more fear about an extended recession because the timeline for recovery was unknown and it could take for years. The question at that moment was, when could businesses go back to normal, and would there even be a new normal? So some even thought we were heading into another financial crisis like 2008. So back to my client to take the story to an important takeaway. So my client's instinct was to step out of the market to preserve the gains he had made and avoid further losses. Because the year before, in 2019, the S&P 500 also reached several all-time highs, closing the year with an impressive overall performance of 29%. However, as 2020 rolled around, COVID-19 began hitting country after country, creating chaos and uncertainty in the markets. Investors, including my client, grew increasingly nervous about the potential impact on the economy and their investments. So my question to you is, if you don't know what exactly happened in 2020, it's fun to play a game. Because what choice would you make? Would you step out of the market when you hear all of this bad news after a great year where you would have gained 29%? Or would you stay invested? In 2020, we witnessed a significant 34% drop in the S&P 500. And my client decided to step out of the market right after his portfolio has recovered and was back in the positive. So he was break even and he aimed to prevent further losses. So I got this email from him on 16 July 2021 and it's in Dutch, so I will translate it for you. For now, I want to stay on the sidelines, Maurice. Taking the growth into account, my portfolio has increased by 4.7% to $899,000 and I'm more than satisfied. I estimate that now the government support measures are starting to taper off, unemployment will likely rise quickly. And after the holiday season in the fall, we will see whether the spread of the virus picks up or not and what the economic outlook will be and whether Trump gets re-elected. I will wait out for now, Maurice. Things could flare up again at any moment, who knows? But don't worry, Maurice. If that happens and I want to come back in quickly, I will come to you and I hope you will be able to arrange it swiftly for me. Thank you, greets John. So we had this client transferred all his money to his savings account. So now let's do some historical simulations to analyze the situation. Was it better to step out or stay into the market? Because it's important to remember that it's much easier to look back now because we are not under the stress of the unknown. When COVID-19 hit, it was a completely rare scenario and the uncertainty was immense. Many feared that businesses might not be able to operate normally for years, leading to panic and drastic decisions. Now, with the benefit of hindsight, we can evaluate the impact of staying invested during that period versus stepping out of the market. So let's see what the historical data tells us about the market performance during similar crises and the long-term implications of the timing the market. So like you see in the simulation, the client started with $900,000 and stepped out of the market with $1 million. What will happen over the next 6 months? Will the market even further collapse? And even though my client stepped out of the market, was it the right choice? As we fast forward 6 months, we observed the market rise from $1 million to $1,139,000, representing an increase of 13.22%. By March 21, 2021, the COVID-19 pandemic had a major impact on the world, with millions of people infected and many deaths. Many countries were reintroducing restrictions because of rising cases, especially with new virus variants appearing. Vaccination efforts were starting in many places, giving hope for recovery, but there were still issues like vaccine hesitance and distribution problems. Economies were unstable, with many businesses struggle to adapt. So, would you choose to wait on the sidelines during uncertainties, or would you step back in, even if it means entering the market at a higher point than if you had stayed invested in the first place? And this is a critical decision many investors face, especially during periods of uncertainty. It's also the point where emotions tend to take over and investors become less analytical, because many don't want to accept that they might have made the wrong choice by exiting, leading them to wait for the market to drop again before re-entering. And this is the reason why some clients are waiting for years on the sidelines, what costs them a lot of money. So back to the historical calculations. As we press the button to fast forward in time by 6 months, we see the market rising from $1,139,000 to $1,225,000, representing an increase of 7.55%. And this growth occurs despite significant uncertainty in the market, with many businesses facing bankruptcy and unemployment rising. By November 2021, the COVID-19 pandemic was still impacting the world, with vaccination efforts underway to control the virus. Many countries experienced a surge in cases due to new variants, leading to renewed public health discussions. While some regions eased restrictions and vaccination rates rose, others struggled with low uptake and increasing hospitalizations. The global economy was recovering, but uncertainties about the pandemic's long-term effects persisted. So, as we press the button to fast forward in time by 6 months, we observed the market declining from $1,097,000 to $1,061,000, representing a decrease of 3.29%. This is also the point where my client finds himself back at nearly at the same level where he exited the market a year ago after stepping out. The real question becomes, do you step back into the market now, or do you still wait until it drops below the point where you originally exited? This is a classic dilemma of market timing, which can be really tricky. Waiting for further declines could lead to missed opportunities, while re-entering too soon might expose you to more volatility. So let's forward to 21 in March 2023. While most investors usually wait to reach their previous exit point before re-entering the market, we decided to move forward 6 months in time. This approach resulted in our portfolio growing to $1.1 million. Over the next 6 months, it increased to $1,152,000, then to $1,324,000, and ultimately reached to $1,410,000. In contrast, my client chose to exit the market and earned some interest on their saving accounts, bringing the balance to $1,113,000. They opted for the safety of saving instead, and this emotional decision to time the market ultimately cost him 26.69% over the 3 years. And of course, there's no wrong decision here, because he bought himself peace of mind, and hindsight always makes things seem easier afterwards. But I wanted to show you this example to experience that when you step out of the market, you have to time the market correctly twice, both when you exit and when you re-enter the stock market. And as we know, over the past 100 years, the market has risen approximately 75% of the time and declined only 25% of the time. When examining the data from the Vanguard website, it becomes evident that despite bear markets and volatility, US equities have demonstrated remarkable resilience throughout history, yielding strong long-term returns. For instance, since June 1996, equities have produced an annual return of 9.7% with a cumulative return of 1,218%. And while this period captures one of the most impressive bull markets in history, it also includes the same global pandemic and 5 extreme bear markets with drawdown ranging from -20 to -55%. Over this 25+ year period, you could always find media commentary of irrational markets, bubbles, and below average return expectations for stocks. And while it's very difficult for investors who kept on investing and were able to tune out the noise, they have been always rewarded again and again in history. So far, 2024 is no different. The US equity market has reached a new all-time high 19 times this year and is on pace to post about a 9% gain for the quarter. Moreover, since the lows from October 14, 2022, equities have returned plus 47% and are now 10% above January 2022 high. So if you are considering stepping out of the market because of all the all-time highs, be warned. My advice remains the same. Stay invested and keep your investment plan in front and center. Don't be misled by so-called experts. Yes, you might avoid a downturn of 50%, but you could also miss out on significant all-time highs of 50% or more. And many so-called experts in the financial industry may claim they can time the market through technical analysis or sophisticated AI trading systems. But I never have seen these people being successful for a period of 10 years or longer. However, it's essential to recognize that truly successful investors like Jack Bogle, Charlie Munger, and Warren Buffett have all faced more than 3 major financial crises in their lifetimes, during which their portfolios dropped by 50% or more. Despite their reputations and strategies, none of them were able to perfectly time the market or exit before these downturns. In the next video, we see the best 26 lessons learned in 68 years of experience from Jack Bogle himself. And these 26 lessons will blow your mind.